is to start with the 7DT trade. And if you can't make money with the 7DT trade, you have no business then doing 0 or 1DT trades or short-term trades, period. If you can't consistently make money with the 7DT trade, then short-term trading is not for you. Into this, we're going to talk about the 1DT trade versus the 7DTE trade. Okay? And we have a course obviously for the 1DT trade, and we have a course for the 7DT trade. If you're going to start with one, you start with the 7DTE trade first. It's an easier process to learn, and it's an easier trade to execute and deal with the ebb and flows of the market. We have went 19 straight months of winning with that 7DT trade and has won, what is that, 78, 79, 80 weeks. That's like 78, 79, 80 weeks, something like that. And we have won all of those weeks except one. That's why I'm saying the 7DT trade is the one you should start with. But the cadence that we use for the 7DT trade is very similar to what we use with the 1DT trade. So it will translate. And the strategies that we use for adjusting will translate to any type of trade that we execute. So that's why we have people start the 7DT trade when we're doing the cohort, right? Or if you join the disciplined trader that we offer, or if you do the apprenticeship, you will learn the 7DTE process. And once you master it, then you'll move to a 1, then you'll move to a 0. But it's a progression kind of process. You kind of get yourself up to that point. Yes, some people start immediate with 0DTE. But I don't know how smart that is if you're not someone that is accustomed to discipline. Yeah, you have to have the discipline. And I don't want people to run into messing up their accounts and things like that. And most of us, just to be honest, most of us do not have the discipline we need initially to be a great 0DT trader. And some of us never have the discipline for it, right? The right discipline to be a day trader. So many day traders fail. And I would argue that the biggest reason is the discipline of being able to follow the strategy to the T so you don't wind up having big losses, and be able to follow the strategy to be able to win, to have the win levels be the way you need it to be to overcome the losses. So in my opinion, Dr. Meadows has pointed out has given us the roadmap with the statistical day trading course. It's given us an awesome roadmap with that 0DT trade, but you need the discipline. And the way to gain that discipline is to start with the 7DT trade. And if you can't make money with the 7DT trade, you have no business then doing 0 or 1DT trades or short-term trades, period. If you can't consistently make money with the 7DT trade, then short-term trading is not for you. Doesn't mean trading period is not for you, because as you guys heard me say in the past, I think everyone at the very least should be doing our safeguard strategy. You shouldn't just be buying stock or buying indexes and sitting and forget and just hoping the indexes go up. It's no reason in the world you can't outperform the market every single year by using our safeguard strategy. And I'm not using hyperbole here, right? And I'm not trying to, have this bellicose type of witching hour today. I'm just really trying to emphasize to you that understanding options, at least to the level of the safeguard strategy, is everyone should be doing. And so if you can't do it with the 7, don't even try with the other ones. Now, to me, if you learn your discipline with the 7DT trade, you should learn how to make money consistently. Just like we've been doing it with it, because it's nothing I'm doing that's great or out of the ordinary. It's all of us can do it if we understand the process and we understand it to the point that we can teach it. We can all do it. And we know where we lack at. We know if we're scared to adjust. If you're scared to adjust, then you do not know how to adjust well enough yet. And you need to keep practicing because it's going to hamper you. It's going to limit your upside. You're
I
not
was
going to
just going
be
to
able to.
add something to your 7 DTE thing.
Mhm,
I think you're right when you say people should really start with that 7 DTE because there's
mhm,
less variables
mhm.
and there's strict rules. And if you learn to follow those, I mean, then adjusting's pretty easy once you know it. But that I 100% agree with you there.
Thank you,
Because of
Susan.
the variables and everything is spelled out. There's not really
Absolutely,
much
absolutely.
question.
Let's just break down the 1DT versus the 7DT. I'm going to start with the 7. And so when we're doing this the 7DT trade, we go and we look at the 7DT and we decide that we're going to look at the straddle price to be able to set ourselves up. And we're trying to go two times that straddle price. So if that was, let's just say 88 times two, that is 176. So what we take that straddle price and I'm just rounding it up and we times it by two, that's going to give us the 176. And then what we do is take that number and we add it to the to the last price and subtract it to the last price. And that sets us up where we want to be. If we were doing the 1 DTE trade, and let's just look at it as the 3DT. This is technically our one, but it's a 3DT because it's a Friday. We're going to do the same thing, right? We're going to take this straddle price, but we're also going to look at the VIX. So that's one of the differences of what we're going to look at. We're going to look at that VIX and do the rule of 16 just to get a feel percentage wise what is the two-time expected move, because that's what it's going to give you, right? This is going to give you that. So if you take that 1872 and you divide it by 16, that's going to give you 1.17%. And if we go and we take this number and let's say we double it, so that's 38. So 38 times 2 is 76. And we take that 76, just like we did with the 7DT trade, and we add it to this number here, plus or minus 1, right? And then, plus, excuse me, not plus or minus 1, but plus or minus. And so we take that 76 and we say 40, 57.43, that's what it's currently trading at, minus the 76. And that's going to take us to the 5667. And I'm just going to show you this for a second. 5667 is just basically, let's just say it's this 5665, right? You can pick the 5670 or the 5665. I'm going to pick the 5665 here. And I'm just going to do the formula, the percentage formula from At the Money, right? So I'm going to take this number and I'm going to subtract it from the last number and I'm going to divide it by the last number, right? So we're going to take the 5665 minus the 5743 divided by the 5743, and that's going to give us basically, like I said, around that price that we just did. And so it's going to give us about 1.3%. So that's around that and this number that we just did with the VIX rule, right? So 1872 divided by 16, and that's 1.17%. Okay. And so that's very, very similar to that. And so this kind of giving me a gauge of where I want to be. And then I can say to myself with the 7 DTE trade or with the 1 DT trade, how did I have to move this? If I didn't have to move it, then I know I'm two expected moves away. If I can move it away, let's say I can move it here, then I know I'm even further away. But if I have to move it up inside of the expected move, then I can kind of get a feel. Did I have to move it 10 points inside it, 20 points, 30 points, 40 points? How much did I have to move it inside the two times the expected move? And the more I have to move it inside the two times expected move, the less conviction that it gives me, at least. Maybe that's not the case for you, but that is how it works for me. The closer I am, or if I'm further away than two times the expected move, that gives me more conviction about the trade. Okay. And so that's those are two of the similarities of the 7 DT trade versus the 1 DT trade. Once we put the trade on, what we're trying to, or set it up that way, what we're trying to do with both trades is we're trying to collect at least $100 after fees and commissions. We are 100% of the time trying to do that with the 7 DT trade. With the 1 DT trade, we can take less. Sometimes we'll take $80 after fees and commissions. Now, when we set the trade up and we get filled, what we're trying to do is put in alerts. Those alerts are more important for the 7 DT than the 1 DT, because the 1 DTE is going to be done that next day. The 7 DT can take another 7 days before it's done. So you want to get alerts to make sure that if something goes wrong, you get notified. But you do not depend on those alerts. Right? Those alerts are secondary notices for you. You should be checking your account at least 3 times a day to make sure things are going okay with your account. It shouldn't be a surprise that, okay, you got an alert. You should know, okay, I'm getting close to an alert probably. Right? It shouldn't be a surprise. Set your alerts though, and then you're also going to set your good to cancels. And you're going to, with the 7 DT trade, you're going to set it for at least 1%. You want to win at least 1%, whatever that is, right? If you collected $100 and 1% is $50, well, you're gonna put your good to cancel for $50, no more than $50, including fees and commission. You do the same kind of concept with the 1 DT trade. Now, once we put the trade on, these are where some of the similarities change. Okay? Because if you go and get the 7 DT course and you go to the part of putting on the trade, the major difference, you guys, is that with the 7 DT trade, we use a 10-point wide spread when we initiate the iron condor. On the 1 DT trade, we use a 20-point wide when we initiate that trade. That's the major kind of setup difference with the actual iron condor. One is 10 points wide, one is 20 points wide. So one is initiating using $1,000 of our 5K that we allocate for every one contract that we start with, and the other is using $2,000 for every contract that we initiate with, using the 5K for every contract. If you don't understand what I'm saying by that, please let me know, because that's a part of the course. That's a part of the courses. We allocate 5K for each contract, and that gives us the ability to be able to adjust in huge or big ways if the market goes against us in a big way. It gives us the ability to counter that big move, and be able to counter big moves at least twice within within the trade. Okay. Now, once we've put the trade on and or set up the trade, we want to set it up at different time frames. The 1DT trade, one of the keys to it is that we put this on no more than 15, or no sooner than 15 minutes to the close. Most of the time, 3 minutes, sometime less than a minute before the close, we're initiating our 1DT trade. And then we're trying to get out of it within the first half an hour of the next day. We're not trying to stay in that trade the whole entire day of that one DTE. That now is a zero DTE. That is not the strategy that we play. The 7DT trade, obviously, it's when we put that on, we usually during the witching hour, and I try to wait to the last half an hour of the trading day during the witching hour, which is currently now, and then we are we put our good to cancel, and if that good to cancel gets hit profit wise, then we've made our money, and that's great. But that's the time frame we have to put it on. But we're not going to get out of it usually the next day. That just doesn't happen very often. We can get out of it in 2 days. That happens a little bit more, obviously. 3 days, 3 to 4 days is most of the time you're going to be able to get out of that trade. But sometimes that 7DT trade, and it's not rare, you're going to have to go to the 0 DTE. Right? You're going to put it on the seventh day, and then it's going to go all the way to that last day, and you're still in the trade. It's just the way it works sometimes. It's not rare. Right? But most of the time, it's 3 to 4 days, or in that time frame, that you're going to be able to get out of the trade. Maybe I should say 3 to 5 days. You're out of the trade with your profit target. So once you have set up the trade, you put it on different time frames. Then you have to understand the risk that is associated with the trades, and understand when to adjust. And then it's a cadence to it.